You are watching Daily Market Pulse. Today is Friday, May 15, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Markets are caught between AI optimism and looming energy shocks, with the Federal Reserve's next move hanging in the balance. Today's agenda: mixed market sentiment, Federal Reserve policy outlook, Bitcoin's role, geopolitical flashpoints, key economic data to watch, market update. Let's start with the big picture. What's driving today's mixed market sentiment? Good morning. Today's market sentiment is best described as mixed, and here's why. We're seeing a powerful narrative around AI driving inflation, which is giving some assets a boost, but that optimism is being met with significant market fragility. Think about automated trading systems and the very real threat of energy shocks. These factors are creating a lot of uncertainty. This tension between AI optimism and the potential for a hard landing due to energy issues is the key story right now. It means investors are trying to balance two very different outlooks. The AI story suggests growth and maybe even rate cuts, while energy shocks scream inflation and a potential economic slowdown. So, while some sectors are thriving, others are showing real caution. The direction the market ultimately takes will depend heavily on how these conflicting forces play out. Pay close attention to energy prices and any developments in the Strait of Hormuz. Those will be your biggest clues. Now let's turn to the central bank that's always on investors' minds, the fee. The Federal Reserve held its benchmark interest rate steady at 3.6% this week. Federal Reserve Chair Warsh confirmed the pause, but here's the key takeaway. The Federal Reserve's updated projections now suggest a higher for longer interest rate path. This means rates are expected to stay elevated through the third quarter. Why? Inflation remains stubbornly high, with April's Consumer Price Index, or CPI, which measures the average change over time in prices paid by urban consumers for a basket of goods and services, surging to 3.8% annually. This is the highest we've seen since May of last year. This higher-for-longer stance is critical for investors. It directly affects how much it costs to borrow money, both for businesses and for us. Markets have been pricing in rate cuts. So this projection creates a potential gap between what investors expect and what the Federal Reserve plans to do. It tells us the Federal Reserve is really focused on bringing inflation down, even if it means keeping rates higher for longer. Now, while the Federal Reserve held rates steady, this outlook did put some pressure on growth assets. However, tech stocks, fueled by that AI optimism we talked about, managed to hit new records anyway. The dollar also strengthened a bit on the back of these higher potential yields. Going forward, watch Federal Reserve speeches very closely. We want to hear any further signals from Chair Warsh about their commitment to fighting inflation. Also, keep an eye on the upcoming economic data, like Producer Price Index, or PPI, which tracks the average change over time in the selling prices received by domestic producers for their output, and the FOMC minutes. These will give us a deeper look into their thinking. Now let's talk about the digital gold, Bitcoin. The digital asset is currently defending a very important level, about $80,000. It's holding this support even as the broader market sentiment is quite mixed. Bitcoin is trading at about $80,500, slightly lower on the day. Two key things. First, we're seeing continued strong inflows into Bitcoin exchange-traded funds, or ETF. This marks 5 weeks in a row of positive institutional demand, which is a significant signal. Second, Bitcoin exchange reserves, the amount of Bitcoin held on cryptocurrency exchanges, have hit a 7-year low. This means there's less Bitcoin readily available to be sold, which can help support prices. This is important because it reinforces Bitcoin's narrative as a hedge. A hedge against what? Against the debasement of traditional money, or fiat currency, and against potential easing from the Federal Reserve. The low reserves mean less selling pressure, and the ETF inflows show big institutions are still buying. Bitcoin has shown some strength by holding that about $80,000 level, and for now, it seems to be moving a bit independently from the S&P 500. The Crypto Fear and Greed Index has also improved, moving from extreme fear to neutral. So what should you watch? Keep a very close eye on those Bitcoin ETF inflows. Sustained demand is key. The S&P 500 is trading at 7,501.2, slightly higher on the day. If Bitcoin starts to move down sharply with stocks, that correlation risk is still there. The next key level to watch for breakout is about $83,000. Turning now to the global stage, where geopolitical tensions are directly Let's turn our attention to the global stage, where geopolitical tensions are directly impacting energy markets. Middle East tensions continue to be a major driver of oil prices, with WTI crude, our benchmark, holding steady above about $100 a barrel. The ongoing conflict, especially involving Iran, presents a significant upside risk to inflation. Why? Because any disruption to supply from that region could send prices soaring even higher. Brent crude, another major benchmark, is also staying elevated at over about $105. This persistent energy shock has a ripple effect across the entire economy. It makes transportation more expensive, it increases costs for manufacturers, and it hits consumers directly at the pump and in their heating bills. All of this fuels inflation. Furthermore, these high prices can actually hurt demand, slowing down economic growth. This is the scenario that could force central banks like our Federal Reserve to consider more aggressive actions, perhaps even cutting rates, to avoid a full-blown recession. So what's the market reaction? Oil prices are holding firm above about $100, supported by these geopolitical concerns. This is feeding directly into the inflation shock narrative we've been discussing. WTI crude is trading at about $100, slightly lower on the day. We're seeing bond yields climb, with the U.S. 10-year Treasury yield around 4.8% and the 30-year yield hitting 5%, which can weigh on growth stocks. What should you watch next? The absolute key is any developments in the Strait of Hormuz and the broader Middle East tensions. Any escalation there could trigger a much larger energy price spike. Also, keep an eye on China. Their actions could be critical in resolving such a crisis and easing these supply concerns. Finally, let's look at what's on the economic calendar this week. This is where we get the hard numbers that shape the market's direction. Investors will be paying very close attention to the U.S. employment data. The big one here is non-farm payrolls, which gives us a picture of how many jobs were added or lost in the economy. This is absolutely critical for the Federal Reserve's decisions on interest rates. Strong job growth might mean the Federal Reserve sticks to its higher-for-longer stance, while weaker numbers could push them towards cuts. Also on Wednesday, we'll get the JOLTS jobs report, which gives us a look at job openings and how many people are quitting or being hired. This provides even more detail on the labor market's health. For investors, this data is like a temperature check on the economy. It helps us understand if we're heading for continued growth or a potential slowdown. We've already seen how sensitive markets are. For instance, hot inflation data initially pushed the Dow Jones Industrial Average down, but a rally in tech stocks brought back some optimism. So any surprises in the employment numbers could cause significant market moves. Beyond the jobs data, keep an eye on Producer Price Index, or PPI, data on Thursday. That tracks inflation from the producer's perspective. Also on Wednesday, we get the FOMC meeting minutes, which will give us a deeper dive into the Federal Reserve's discussions. And don't forget about Federal Reserve speeches on Thursday. These can offer clues about their thinking. Finally, on Friday, we'll see retail sales and consumer sentiment data, which tell us about consumer spending habits. So, a lot to digest this week. But the jobs report is definitely the headline. Now let us turn to today's live market snapshot, where gold, crypto, stocks. Now for our daily financial market update. Here is where the key asset classes stand as of Friday, May 15, 2026. Gold is trading at about $4,560, lower on the day, and is sharply lower over the past 5 sessions. Silver is at about $79, sharply lower today, and sharply lower over the past 5 sessions. In crypto, Bitcoin is at about $80,500, slightly lower on the session, and lower over the past 5 sessions. Ethereum is at about $2,250, lower today. Other major crypto, Solana at about $91, lower. BNB at about $684, slightly higher. XRP at about $1.466, lower. On equities, the S&P 500 at 7,501.2, slightly higher. The Nasdaq at 26,635.2, slightly higher. The Dow at 50,063.5, slightly higher. Internationally, the DAX at 24,078.5, lower. The Nikkei at 61,409.3, lower. The FTSE at 10,233.9, lower. On the bond side, the 10-year U.S. Treasury yield is at 4.5%, slightly lower on the session, and the 30-year yield is at 5%, slightly lower. Yields remain in focus as the market watches for Federal Reserve signals. Rounding out the macro picture, WTI crude at about $100 per barrel, slightly lower. The dollar index at 99.25, slightly higher. Euro dollar at 1.162, slightly lower. The picture is mixed across asset classes, with no dominant directional theme yet. Investors are watching macro catalysts closely before committing to a clear risk stance. So what does today mean for you? The market is a tug-of-war between AI optimism and real-world energy risks. While Bitcoin shows resilience as a hedge, watch for those key economic data points and geopolitical developments to guide your next moves. Thank you for your attention, and we will see you again tomorrow.